thanks for making the time to join us on the podcast. We just saw each other, Bay Area, at the Brazil at Silicon Valley. It's good to catch up with you.
Likewise, Brian, and thanks for having me. It's a real pleasure to be here. Good to be reunited, and congrats on everything you're building in Latitude. It's a phenomenal initiative. I think a very strong pillar and foundation for the region. So thank you for everything you do for the community. Truly exceptional.
No, thank you, man. Hopefully we can grow the number of companies that you get the opportunity to look at. The idea is we grow the pie together. We're at an interesting moment because the volume of companies is slowed down that are being created.
Yep.
But there definitely is going to present some good opportunities over the next couple of years. And just as a little bit of context, funny enough, you were actually an investor in my company. We're still waiting for those payouts on some of the
That's
things.
Right.
So we released a little bit of money, and we got some more money coming in November. So that's good.
That's what I hear.
I'm still working for you, man, over here, like in multiple capacities. So trying to get more companies so that you can invest in, and then trying to monetize the last bits of our deal here. But anyways, it's part of the game. It's never easy, you know. This thing takes a long time.
It does. It certainly does. It certainly does.
And let's talk a little bit about you. You know, you've been working mainly with growth equity, and I met you back in the day because you were working at Vulcan when
Yep.
we met, and you were Vulcan. For those that don't know, is Paul Allen's fund. So Paul Allen, Microsoft obviously made a lot of money there, and decided he wanted to just. What was the thesis on Vulcan? It was pretty interesting because it's very different than most firms, right?
No, that's right. That's right. And just to give you a little bit of background and context, Paul was a co-founder of Microsoft alongside Bill Gates. Like Bill, he stayed at the company up until about 86 as an executive. And then for personal reasons had to depart, and then came back at various roles. And Vulcan was really a culmination of a variety of interests that Paul had, as you can imagine, ranged from bulk of it philanthropy, science, and investments, particularly within tech. And Vulcan Capital specifically was, you could argue his family office or investment arm, SOLP fund, which gave us the ability to think very long term, and also the flexibility to explore different regions of the world in the pursuit of the best risk reward. But it was, very much institutional in nature, right? We thought as a traditional growth fund, and went about investing that capital similar to other growth funds in the marketplace, with the caveat of having an evergreen pool of capital, which on one hand allowed us to think very long term in nature, and to be very flexible on stages, check size, and geographies. I joined the firm in 16, and I was there until the beginning of 22.
That's awesome. You've been doing this for, I guess, since 2016 at Vulcan, but I guess you've been investing in startups for about a decade, right?
That's right. That's exactly right. Prior to Vulcan, I was at a large growth equity firm called Summit Partners, that's been around for, close to 4 decades now. Very well-established firm. And that's really where I cut my teeth, if you will, in the world of growth investing. And then dating back to 2013, that's when I first wrote my first check into LatAm. It was a company called Banco Fácil, founded by a gentleman named Sergio Furio. That went on to become Creditas. Frankly, was looking at the right place at the right time. And that was really the start of investing into LatAm. This was 2013, not, over 10 years ago now. I'm sure we'll explore this throughout the podcast, but suffice to say, the ecosystem was very different than it is today. And if I recollect correct, that was about a $15,000 check that I wrote. A lot of the savings I had at the time, but I had this deep passion for one, technology, and two, to frankly help entrepreneurs out of Brazil, which that's where I'm from, but I've been in the US for the last 20 plus years. And being one of the few Brazilians in Silicon Valley, I thought, hey, there's something unique I can bring to the table, as these two worlds were much further apart than they are today. And, that was the start of, a lot of things that have happened since.
I love that. It's, first of all, being your first angel check and then investing in Sergio Furio. First of all, Banco Fácil, I mean, I saw that what Sergio was building at the time because he came over to my, crappy office and talked about a partnership because he was like looking for mortgage leads. He was working with like Santander,
That's right.
all this stuff. And man, that company definitely changed quite a bit and not bad for your first check. I mean, I wish I could say the same thing for my first check because my first check evaporated in 9 months.
I think it was perhaps more fortuitous luck than perhaps skill. Let's put it that way.
Hey man, you got to do some retrospective rationalization there. You're in the right place, the right time because you're a good investor. But so 10 years ago, interesting insight that you've got around the U.S. bridging these two markets, Latin America, Brazil, more specifically, and we'll get into your thesis today in terms of across capital and what your plans are. But before that, love your thoughts on if you could synthesize what you think. Besides the obvious stuff of like more mature ecosystem, but like what are some of the really kind of specific things that you've seen that have evolved over the last kind of a decade plus, and where are we in the cycle in Latin America?
Sure. Look, I think to a larger extent, all started in a couple cycles ago, and maybe in 13 when we were talking about what Sergio was doing. Everybody came to a realization that innovation is happening all over the world. In large part, that was due to technology innovation, which I won't go into it, as a lot of folks are fully aware of it. But it was just thought that, whether it be in China or in India, which were, despite being emerging markets, largely more mature ecosystem from a startup, VC, and capital markets as a whole than Latin America, is that value is being created across the entire world, right? With disruption occurring, initially, frankly, with copycat models, right? Whereby you had, what I like to call the 1.0 versions of, the eBays occurring or traditional internet marketplaces occurring in emerging markets, whether it be, Alibaba in China, which certainly went on to become a massive company and a defining company for that matter. We invested in Vulcan, Flipkart in India, which was also a company that Vulcan invested into. Souk in the Middle East. So the point here is innovation was happening all over the world. I think as relates to LatAm specifically, if you take I like to take a macro and micro view as to what transpired over the last 10 years. I think the macro, you have 10% of the world's population within the region. Very strong demographic backdrop. We tend to skew younger. We are actually wealthier and higher online engagement than our counterparts in China and India from a GDP per capita standpoint. So that was quite favorable. And I think investors started to look at that and pay more attention to it. On the micro side, what we seen and observed, frankly, over the last 10 years was, I like to break it down into three buckets. One is people and talent, capital and regulation. People and talent was something we saw, certainly happening in the U.S., whereby talent was leaving traditional industries, particularly those that are graduating from top schools that tended to go to investment banking, consulting, really gravitating towards tech. That took a while, but certainly started to happen within LatAm. Two was capital. Back in 2013, there was probably 2 to 3 institutional venture funds in the region, whereas certainly that has multiplied quite significantly. And now we have a well-established ecosystem of seed Series A funds, which certainly helps the burgeoning of the ecosystem. And then we had a favorable backdrop, particularly in Brazil, say that favored innovation in certain sectors. So the combination of all these factors really drove capital and attention to the region, particularly late in the last cycle. And for us, more specifically, that was a big piece of what got us paying attention to the region. And then, frankly, very simply put, what we saw was businesses that were growing faster, with better margins, and more efficient, and frankly, oftentimes at better valuations. I'm not going to say it was all the time, But this was when we first started investing in 2018 institutionally into the region. In a very simplistic way, that's what we saw, and that's what attracted us to LatAm.
Rafael, interesting insight that you got this global perspective, right? Because you're looking at business all around the world, and you look at Latin America, you see certain trends happening. And it's interesting you mentioned this kind of price piece because Latin America maybe was priced better in 2018. And then I've talked to a lot of other investors. I saw Keith Raboy at a wedding, and this is a while ago. And, he was saying he thinks Latin America has been way too expensive. And maybe now we're kind of like finding some kind of middle ground. How do you see, price discovery around growth companies? Obviously, things have come down quite a bit. And so it's probably a favorable time to be an investor. What do you think about kind of pricing in Latin America now, given that you have this, more global perspective? Where are we, in the opportunity cycle for growth investing?
Sure. No, Brian, I think, look, we've gone through a couple cycles, I'll say, in LatAm, and cycles in LatAm tend to be shorter than in the US, let's put it that way. So we've seen more cycles in a short period of time. Let's call it 2013 through 18. I think the gap in valuation was quite wide, and in large part was due to the fact that capital is scarce. So you, as the capital provider and investor, you had a lot of leverage in setting terms, and entrepreneurs and companies were starved for capital. So that, certainly the pendulum was in the investors' court in a big way. In 2018, as capital started flooding into the region, progressively we saw that gap converge within the US. And for a period of time, frankly, to your point around Keith's comments, we did see multiples in the region that were higher than in the US, which frankly is hard to understand. Let's put it this way. Obviously, there's a lot of nuances that go into valuations, right? As you're fully aware, whether it be the growth, the profitability, the potential, the liquidity, the risks. There's part art, part science to pricing these investments. Where we are now, I think we're not back to the 13 levels, but we're certainly at a point in which there's a bit of discovery taking place. There is a wide gap still in, bid ask. Some entrepreneurs are still thinking we are in the 2021 levels and really, comping themselves to where their competitors may have raised money, to where they thought their companies were worth. And the reality is the world has changed and has changed in a pretty big way. And then within LatAm specifically, if you want to take a very finance 101 view to valuation, you should trade to some extent at a discount. And we see that in the public markets. Whether companies that are listed publicly from LatAm, they tend to trade at a discount to their public peers in the US. In part is due to the size of those companies, the liquidity of the companies. So there's nuances around the public markets there, but there's also nuances around currency risk. There's nuances around macro risk that investors are certainly factoring in. So that should be factored in. The counter to that is kind of what I had mentioned earlier. Some of these companies in the growth stage, they're frankly growing faster with much better margins and unit economics than their US peers. We're seeing this firsthand. And there certainly are these, true unicorns, let's put it that way. They are highly profitable, high growth, highly efficient in LatAm that can stand up to any US peer. And as a result of that, they should perhaps trade it at a premium. So it is a balancing act when it comes to valuation. And when it comes to your question around where we are from a growth valuation standpoint, I think we're still in the discovery phase, given where we are in the cycle, right? There was a big change that occurred, but we're seeing deals get done. What
are the characteristics? It's interesting to hear that there's there's this variance between trading under their US counterpart and then some that are actually just better. When you see these opportunities or these companies that are just uniquely positioned to just be more profitable or have better margins or than their US counterpart, what is it about the market dynamics in Brazil or Latin America that allow for that to happen?
Yep. That's a great question. Something that we think very deeply about, given part of our thesis for LatAm is centered around business models that work better in the region. And that may have to do with the regulatory backdrop, but something with has to do with the structural nuances of a given industry. It is our belief that emerging markets lend itself to a winner take most, winner take all dynamic, which frankly, I think in this cycle with more scarce capital, we actually see this play out. Um, Two is the idea that, the structures of certain markets, and I'll try to pick a few examples, provide for more of a platform play, whereas in the US, you have a lot of point niche solutions that are nibbing away value across the value chain. Whereas in LatAm or other EMs, you have this opportunity of being an end-to-end platform and capture the full value of that given market or value chain, if you will. Frankly, I believe at least, some entrepreneurs in LatAm tend to be scrappier than their counterparts in the US and run more efficient business. That is a byproduct of the environment they quote unquote grew up in. And why I think some of the entrepreneurs that grew up in a environment where capital was more expensive or scarce, they tended to make better resource allocation decisions and build better businesses. They had to be profitable from day zero because there was no capital for them. They needed to reach profitability earlier. So there are those elements to it.
I want to double click on this kind of full stack approach, because I think that that's one thing that I actually recall this from Vulcan. I spoke to one of your colleagues back in the day, and I remember he asked me about the value chain associated with real estate, and we talked about like what would a full stack solution look like. And at the time I hadn't really been candidly hadn't been thinking a whole lot about that, because we were focused on just like aggregating the data. And but it was like one of the first times I was like thinking about the entire kind of value chain. And it sounds like that has been like there's been different trends and different cycles. When you think about going more verticalized or kind of full stack, sometimes it's more expensive, right? Like, because you've got your operating costs are higher. Let's say that you're a logistics company, and then it's like, do you buy the warehouses also, and do you build the warehouses also on top of everything, and along with like the other distribution parts. Just as an example, I don't know, I'm thinking Logi or others. I was talking to a company yesterday that in order for them to expand, they needed some investment in warehouse space. And, like that could build massive defensibility, because if you're like delivering to e-commerce and you've got like, massive penetration in the major areas where you can increase shipping times and all that stuff, but it's also quite expensive. So like, where are you right now on kind of, evaluating those companies that maybe have higher CapEx, maybe have more, verticalized and more, kind of expensive to operate, but build in defensibility long term?
Yeah.
Where's the market on that right now? And where are you on that? Because everyone wants super juicy margin businesses that are like, straight software and, but Latin America, it's hard to build all that stuff exclusively because there's some infrastructure that's lacking. So would love your thoughts on that and where they sit.
Yeah, I think that's a phenomenal question. And to your point, capital intensity. Investors tend to have a bias towards capital light businesses. Everybody likes high margin businesses where you have margins that increase over time and moats that make your business more defensible over time. And everyone's fairly familiar with that. I think that the reality is on the ground is not as simple, right? I mean, particularly in an emerging market where some of the infrastructure may not be there, and there lies the opportunity, but may require additional capital to get to the end state. But by getting to the end state, you're going to capture more value. I think I'll use the real estate market as an example, one in which you're extremely familiar with. There's no MLS, there's no broker exclusivity, mortgage penetration is extremely low. Products such as the title insurance is non-existent. But building all this, not only takes time, but it is fairly capital intensive. And the question then becomes, in what sequence do you do it, to provide you the better edge. And then how do you do it in a manner in which, doesn't require an abundant amount of capital, right? Where you can create a wedge, from that wedge, generate some value and parlay that into a second, third, or fourth act. And as a result of that, have an end-to-end platform. In a cycle in which you have abundant capital, you tend to have the necessity to do that quicker and raise more capital to do so. In the current market, my view is, you will have less competitors funded that quickly. And as a result of that, you got to move extremely fast, but you can be more cognizant of how we go about doing that. And we certainly saw this, with companies that I worked with, thinking about expanding geographically, in the Series B. It's like you haven't even penetrated your core market. Why are we even thinking about going, to Mexico, Colombia? Let's first get our Act 1 done well. Let's use this quote unquote mine to finance our second or third act, whether it be geo expansion or adjacent markets or products and value prop, to therefore build this end-to-end platform we were alluding to earlier. The reality is there's not a one answer that fits all. Here, there's a lot of nuances depending on the industry, depending on the competitive environment, depending on access to capital. But you're absolutely right. I think we'll see a lot of businesses that can be great businesses once they reach great scale, but they need to reach that scale. And in order to get to that scale, they need a lot of capital to do so. You struggle to get to that end state in an environment where we have less capital.
So you mentioned a handful of inflection points, whether that be geo expansion or tangential kind of offerings. On the geo expansion, I think if you could take a step back and give us the thesis for across capital, I think that there's no secret. Across probably refers to a little bit more of across the market, different countries, and you've got kind of those U.S. roots with Vulcan. Talk a little bit more about what the opportunities you see,
Yes.
From a regional or global perspective.
Totally. Look, I think just to give you a little bit of background, the thesis for across evolved quite naturally. Was one that we, to some extent, stumbled upon, I'll say, where, in 2018, we talked about this earlier, we started investing in Latin America. We had the great fortune working with great entrepreneurs in the region. As we, got known for investing in the region, some of our portfolio companies within the U.S. sought us out as somebody that could help them penetrate the region as they thought about geo expansion. So we helped, a lot of companies think through how they may crack that market. And these are US based companies looking at LatAm as a market, to expand into, whether it be the likes of Uber that everyone's aware that has, very prevalent, position in Latin America, or a cybersecurity company that was selling solutions to banks in LatAm and helping them think through that. So the thought here is, by investing across both of these markets, we have an edge through the investment lifecycle, whether it be how we go about identifying the companies that we want to develop a relationship with, how we go about diligencing them and thinking through business models that may work better in LatAm or in the US, adding value subsequent to making the investment. And here is, thinking through how we really make this cross-border a value-added asset for our investees, which, it really evolves around talent, evolves around business models, business development, capital markets, so subsequent financing, and functional best practices. So that's how we think about it. If you think about, it's not necessarily recreating the wheel, but there are a lot of great firms that were built around the same pillar. Whether you want to look at a GGV that really started by, bringing together Asia and the US, whether it be Index with Europe and the US. We think LatAm and the US, there's natural reasons as to why this should be even easier given, geo proximity, cultural proximity, and the sheer opportunity that exists within LatAm for U.S. companies. And frankly, LatAm-based companies also winning in the U.S. That's a big part of our thesis as well, where we help companies that are born in the region scale globally, starting with the U.S.
You once said, I don't know if it's you or some of your firms said, that the fund size is the enemy of returns. And there's another phrase that I like, which is your fund size is your strategy, right?
Correct.
Which, so I like both of those phrases. Talk a little bit more about what you mean in terms of fund size, the enemy of returns. You've got more of high concentrated portfolio. Explain why you think that's the right thing for across.
Yeah, no, I agree with both of those statements. I think fund size is certainly a strategy. As far as fund size is the enemy of returns, I think if you look at empirical data, it tends to show that as funds scale, the returns tend to go down. I think part of that is, and I'm not an allocator, but part of that is, you don't keep the bar as high. You start building an index fund. So you're also buying much more of a beta risk, if you will, and beta performance than generating alpha in investor speak. For us within Across, we always have invested in a concentrated fashion. We like investing in a concentrated fashion. It allows us to, one, dedicate a lot of time and resources to the companies we partner with. Two, it provides us with a very high bar as far as making any investments, right? So we're actually in the business of saying a lot more no's than yes, unfortunately, and we like that. We appreciate that. And the last piece here for us is by being concentrated, we're not buying just call options. I like to say the best relationships are relationships that you're meaningful to one another. I want to be meaningful to the companies I partner with, and I want those companies to be meaningful to me. I don't want to be a call option for the company, nor I want the company to be just a call option for me. So that's the way we like to one, partner with entrepreneurs and build relationships. Two, how we want to allocate our time and resources in a concentrated fashion. And thirdly, it is how we think we can, generate good risk-adjusted returns.
So what does that translate into in terms of, portfolio size and maybe equity concentration in the companies? Like what's your target equity stake, et cetera?
Yeah. So we're looking to build a portfolio of 8 to 10 companies. Our check sizes tend to range from 5 million in the low end to north of 25 million on the high end. In terms of concentration, we'll, make a position within the fund up to 20%. So about a fifth of the fund can be, at cost, just a single position. And that's how we think about it.
You've also mentioned in the past that you have this kind of research-driven and thematic sourcing of companies, which, I think makes a lot of sense if you can do that if you have a lower volume of companies because you can get really deep into specific topics. And I've also read that you spend 17 months on average doing that theme research and getting to know, those businesses in that sector. Talk a little bit more about in practice how that works.
We like to take a tops-down, bottoms-up approach to sourcing. On this research side is the tops-down piece where we start at the market level, deconstruct the market, get to understand the market drivers, the various players, the value chain, the themes and trends, and we have a fairly systematic approach about going about that. Ideally talking in building relationships with the various players within that given market. So we truly become an expert. And that expertise ideally allows us to actually be better partners to those companies as well. And the 17 months getting to know the companies prior to making the investment, it's what has taken us on average. I think that allows us to build a real relationship with those entrepreneurs. And for the entrepreneurs to get to know us, for us to get to know them, understand their business, understand the evolution of, product, go to market, financials, team, even the entrepreneur themselves, and for us to add value to them and earn our seat at the table as a value added partner. I'm not saying every single one of them takes 17 months. We can move very quickly as well. But given the stage in which we invest, we start tracking these companies fairly early on, right? I mean, and that gives us the ability to move with conviction and speed by the time which they get to our strike zone, and also be ideally value added as someone they've gotten to know over an extended period of time. So that is a thought process behind, one, taking our time to invest, and then two, have this thematic approach towards understanding markets.
Yeah, so I guess the takeaway there, a couple things. One, for clarity purposes, your investment decision is obviously much faster, but you start tracking these companies and you want to build a relationship with these companies. Given that you're doing a limited number of investments, you're going all in with them and you're going deep with them. So you're not building a 50, 60 company portfolio, and therefore you can go a little bit deeper and spend time with them. So I guess the lesson there for founders is it is, and I was debating this with a founder the other day. It's like, should you be meeting investors when you're not fundraising? And I think the answer is yes. As the CEO, depending on where you are as a company, obviously if you're pre-product market fit, don't even worry about it. Focus on the customer, because you got to get there in order to get to the next kind of stage of development. But if you've got a management team in place, you're executing, probably as the CEO, building relationships with those key people. It's super important, because especially in today's market where the velocity of deals probably is slower than it was in 2021, where you're not flying up and walking down Sand Hill Road and expecting term sheets on Monday. It's a different environment. And then lastly, the founders that did do that, kind of the shotgun weddings, you want to make sure you're partnering with the right people, because it's a long-term game. So I guess the lesson there is for founders, even if you're not fundraising, building a relationship with investors, getting to know investors, and then, asking the investor lots of questions to kind of understand how they think about things, interviewing the investors along the process, because it's a two-way street.
Yeah, I think that's precisely right, Brian. I think, it's a balancing act. You don't want to be fundraising at all times, but you are fundraising at all times. So building a systematic way about, updating those investors. And then ideally, you also have a short list of those that you perhaps allocate a bit more time towards, and those are the ones that you like to eventually partner with. I think it's a very smart approach towards fundraising.
So we were just talking before about this, and you're now closing your second investment. We won't get into all the details there, because some of this stuff is confidential. But you've closed one investment, you're closing on your second investment. Talk about the fund size and then deployment cycle.
Sure.
For those that are listening, how long do you think it'll take to deploy the funds? What do you tell LPs around that?
Yeah, that's right. But we are a $100 million plus US dollar fund. I mentioned earlier, 8 to 10 investments out of the fund is the goal. As far as deployment cycle, we foresee deploying the fund in 3 to 4 years. We like time diversification. We think it's important to add that to the portfolio. We are very cognizant also of where the market is today. It is a dynamic one. We're not in the business of necessarily timing the market. We're in the business of investing in great companies. So we are less concerned about the velocity or the pace of deployment, and more concerned about the quality of companies we're partnering with. So that's how we think about the deployment cycle. We can take up to 4 years. We can do it within 2 years. That's going to be highly dependent on the quality of opportunities that we come across, which, candidly, we've been very impressed by the opportunities we're seeing in the marketplace. I think it's actually is a very interesting time to be an investor, but I think a fascinating time to be an investor and entrepreneur. Absolutely.
You said that you're actually excited to launch ACP right now in this time of uncertainty, because you're long-term committed to LatAm. You're from Latin America and you've been investing in the region for a long time. So maybe talk a little bit more about what this moment means for LatAm startups, investors, and founders, and what's your vision for when the scenario finally clears up, because it is hard. And so besides pricing being better and founders being more realistic, what do you like about 2023?
Sure. Sure. Look, it is a challenging environment for everybody across the ecosystem, right? For early stage fund, growth funds, late stage funds, entrepreneurs, established companies, public companies. So I think everybody's feeling the pain. That's just the reality. So we're all to some extent in the same boat. I think I tend to be a glass half full individual, and that's the approach I take to everything. And the reality is, like, say, we're back to basics. We're back to what fundamentals are. And the glass half full approach is, if you have a sound business and a great company, there's going to be capital there for you. And guess what? The likelihood of having a competitor raise money to compete with you, I think, has gone down dramatically. So as a result of that, you can capture a lot more of the market and the value that you create. I think in the latest cycle, we saw a lot of businesses that should have been winner take most, winner take all. And, everything lent itself to that, and ultimately did not happen because capital is so cheap and competitors came in and raised capital very cheaply. And therefore, value got spread across different players. I think the other piece is talent, right? I mean, we had a very fierce competition for talent. I think all of a sudden, you'll see a place in which you can attract great people, and people that want to be there for the long haul, and not necessarily just for the short stints and equity accumulation or what have you. So I think that's the second piece that I think it's very relevant. And the third one is this notion around long-term commitment. I think a lot of tourists will leave the market, and this is across both the entrepreneur ecosystem and the investor ecosystem. On the entrepreneur ecosystem, I think, a lot of people were alert to the whole entrepreneurship startup mentality because it's almost like a get rich scheme. And I don't mean this in a bad way. But entrepreneurship is extremely hard. And you need very resilient people that are willing to go through, the tough times. And I think that's going to weed a lot of noise out of the market. And same on the investor side. I think a lot of people thought investing was very easy. And started investing and throwing money around, but to put it blunt. But it's actually very hard. So I think a lot of those tourists will also exit the market, and what we'll be left with, it's like I alluded to earlier, is back to basics, which I think it's a good place to be.
One last question, on that topic of tourists, investors, and entrepreneurs, the flip side of that is, on the investment side, is that there's less people willing to mark up your investments because the pool of capital has gotten smaller. So how do you navigate that as a growth investor, where the tigers or the larger checks that come after you typically pulling back, and there's still money there, obviously, but it's more scarce, and so that affects your kind of investing as well.
Yeah, no, it's a great question. Something that we factor into the businesses we look at. We have a bias towards businesses that are profitable. We call it fully funded. So they own their own destiny. So there's not a necessity for them to raise follow-on capital. Is much more a nice to have because we have good uses for that capital, but we don't need that in order to survive. So that's the mindset we're approaching the current market with. Is a mindset we tended to have all along. And the reality is we're less concerned about the markups, as you alluded to, and much more concerned about the end goal, which is to build sustainable long-term businesses that can stand cycles. Easier said than done, but that's kind of what we are very focused around.
Yeah, I guess that if you're investing in businesses with good fundamentals, things will take care of itself, is the summary. I mean, because these are great companies, they're going to be here for a long time. And then, I mean, there's obviously a point of liquidity that you have to find, but that happens if the business is profitable and doing well.
That's precisely right, Brian. I think that's the mindset we have. Liquidity, it is top of mind for the whole industry. It is something that's extremely top of mind for us. Exuberated in LatAm. So the depth of the LatAm market from a liquidity standpoint candidly is shallower than in the US. Just the capital market as a whole is less sophisticated and less developed. But we're still very optimistic on, what liquidity looks like for the region, particularly for those companies, as we mentioned earlier, that own their own destiny.
Well, thanks, man. Exciting stuff. Glad to see more investors in the region that have been working in the region. You're obviously clearly committed to the long term of Latin America, and that's what we need. We need that solid. And I'm happy to say that comparison to when I started, there was not a lot of local capital, and it was limited number of investors, small funds. Now we have we've got a more robust ecosystem, and despite the uncertainty of the moment and less capital being deployed, these are cycles. They say cycle for a reason, and it's going to cycle back. But the good news is that it's not that everyone's disappearing. It's that it kind of shows who's really long term committed.
Totally, absolutely. It has evolved a lot, but I think we're still in the early innings, and the future looks promising.
Awesome, man. Well, we're going to be here for the next 10 years, so it'll be fun to have this conversation. You started, your first investment in 2013. It's 2023. Let's see where 2033 lands, man. But hopefully we'll have you back before that. But yeah, man, congrats on everything. Excited for Across and what you're building.
Thank you, Brian.